Welcome to the Pro Ticker Deep Dive. Today we're digging into something that really touches everyone, tariffs.
hmm
And this big question, when import costs suddenly shoot up, do you feel it right away at the checkout? Or does it sort of sneak up on you?
Yeah, like a slow burn.
Exactly. We're going to unpack this idea of tariff creep today. We want you, the listener, to get how this works, how the costs might build up, and maybe why the market could be underestimating inflation going into 2026.
It's a critical point because, honestly, tariffs have really shaped the whole economic story of 2025. They ramped up way faster than I think most people expected.
Faster.
But the impact on prices, well, it hasn't been that sudden jolt. And that's where the risk is. People might think, oh, inflation's beat, but the pressure is still there,
Yeah.
just delayed, spreading out.
Okay, let's put some numbers on this. So the official, statutory tariffs on goods coming into the U.S., they started 2025 averaging, what, about 2.5%?
Around there, yeah, pretty low.
And then by mid-year, boom,
hmm
almost 17%.
It's a staggering increase, really, a massive shift in costs for importers.
Now, based on how things usually work, what would you expect that to do to prices?
Well, the standard thinking, the sort of historical math, is that roughly half of a tariff cost gets passed through to consumers.
Okay.
So if you just applied that logic straight, that jump to 17%, it should have meant a pretty big immediate hit, maybe 70 basis points added to core inflation.
Right, a noticeable bump. But we haven't quite seen that, have we? So why not?
Yeah.
How are importers managing to soften that blow? We're feeling something closer to an 11% effective rate, not the full 17%. What's bridging that gap?
That gap, that difference between 17% and 11%, that is the tariff creep in action. It really boils down to, well, frankly, how creative businesses have been.
Creative.
Yeah, with their supply chains. Look, importers knew they couldn't just eat a 17% cost increase, but they also knew passing it all on instantly would, freak out customers.
Alienate them, yeah.
Exactly. So they got clever, they engineered workarounds.
Like what kind of engineering are we talking about?
Well, completely rerouting supply chains is a big one. Shifting where things are made or assembled to countries that don't have those high tariffs.
Okay, that makes sense.
They're also digging deep into trade rules, finding very specific exemptions, sometimes even making small changes to how a product is processed just so it legally counts as originating from a different lower tariff country.
Clever, but sounds complex.
Oh, it is. It's expensive, takes time, but it achieves the goal. Stretching out the pressure, turning what should have been a shock into this slower creep.
And the timing worked out for them, didn't it? Because the consumer side has been reasonably okay. Wages holding up, jobs are there.
Right. And households still had a bit of that pandemic-era savings cushion left.
So that resilience gave companies room to maneuver, to test the waters with smaller price hikes.
Precisely. They could try, say, a 2% increase one quarter, maybe another 3% the next, without worrying that demand would just completely collapse overnight.
You can actually hear that caution if you listen to company earnings calls, right?
Oh, absolutely. The language has shifted. It's quite telling. Earlier in the year, you heard CEOs talking very openly about pricing power, like, we can raise prices, no problem.
Yeah, I remember that.
Now, it's different. They frame price increases more carefully. It's part of competitive dynamics, or they talk about it in terms of future planning. It's much less aggressive. They're clearly worried about pushing too hard, too fast.
That caution, that sort of tightrope walk, it ties right back to inventory, doesn't it? That seems like the real key to the delay.
Inventory's crucial.
Absolutely.
Absolutely.
I mean, why didn't that 17% hit us harder last spring or summer? It's because shops were selling stuff they bought before the big tariff hikes kicked in, right?
Exactly. For most of the first half of 2025, retailers were working through older stock bought at pre-tariff prices. That created a huge natural buffer. It protected their profit margins and, importantly for consumers, kept the price tags relatively stable for a while.
Okay, so that buffer gave everyone some breathing room.
It did, but buffers don't last forever. That's the critical thing to understand. As we get towards the end of 2025, and especially as we roll into 2026, that old inventory is going to be gone.
Depleted.
Completely. So the new stuff hitting the shelves, that's going to be fully loaded with the tariff costs. Maybe not the full 17% everywhere, but certainly reflecting that higher 11% effective rate or more for the first time, really.
So you describe this as a slow tide rising. Why is spring 2026 the moment the tide really hits the shore? What makes that season the crunch time?
Because that's when several things collide. You've got the delayed, built-up cost pressure finally hitting. You've got peak seasonal demand, especially for spring and summer goods clothes, outdoor stuff.
Right, new season inventories.
And crucially, there's no more old, cheaper inventory left to cushion the blow. That specific transition point as companies stock up for spring, that creates what we're calling the spring 2026 risk window.
It's the real test then.
That's the moment of truth. Will shoppers just accept these structurally higher prices for everything from, patio furniture to new running shoes, or does demand finally buckle under the weight of both the gradual creep and the fully loaded new costs?
And we're already seeing hints of this, but it's uneven. The analysis suggests some areas are feeling it more than others already.
Definitely not uniform.
Home goods, recreation stuff, prices seem to be ticking up there already.
Yeah.
But things like clothes, shoes, maybe cars, seem slower to reflect the costs.
Yeah, and that difference comes down almost entirely to two things: how much competition there is in that category and how loyal you are to specific brands.
Brand stickiness.
Exactly. It's a huge factor. Think about it. Some companies can pass costs along because their customers love the brand and will pay a bit more. Others have to absorb the costs because if they raise prices, customers will just walk away.
So who are the winners in that scenario?
The clearest winners: luxury brands, premium goods, high-end accessories, designer handbags, maybe sneakers over $150.
Where the brand itself is a big part of the value.
Right. Brand loyalty is intense there. Those companies can probably push through, say, low to mid-single-digit price increases, maybe even mid to high in some cases. Their customers are just less sensitive to price, and that loyalty shields the company's margins.
But contrast that with, basic clothing.
Totally different story. Mass market apparel is hyper-competitive. Brand loyalty, often pretty low. If you hike the price of a basic t-shirt or jeans by 10%, you risk losing that sale immediately. Someone will just buy the cheaper option next to it, or the store's on brand.
So much harder to pass on costs there.
Much, much harder. They have very little pricing power, relatively speaking.
What about off-price retailers, like TJ Maxx or Ross?
They're interesting. Their whole model is built on buying opportunistically, often taking excess inventory. That gives them some flexibility. They might be able to absorb some of the tariff pain or find deals that others can't. So for value-focused shoppers, they might look relatively stronger in this environment.
Okay, so let's connect this back to you, the shopper. What does this all mean for your wallet and how you buy things? It sounds like we're seeing a split.
A definite split, a bifurcation, really, in how people are behaving.
On one hand, higher income households. They seem okay absorbing, say, a 5% or even 10% increase on those premium items they really want. Their finances are stronger.
They can handle it, generally. But it's different for middle and lower income shoppers. They're showing clear signs of price sensitivity.
How so?
We're seeing them actively trade down, more value shopping, using more coupons, definitely shifting towards private label store brands, trying to offset these creeping costs wherever they can.
And that split is likely to get wider.
The longer this tariff situation continues, yes. The retail landscape could become even more divided between premium resilience and intense value seeking in the mass market.
Okay, let's pivot to the investment side. For people looking at the market, what does this environment mean? It sounds tricky.
It creates a landscape with, both landmines and potential opportunities. And it really hinges on those two factors we talked about: pricing power and supply chain agility.
So, the opportunities are with.
Well, firms that saw this coming maybe diversified their sourcing away from high tariff regions years ago.
Proactive moves.
Right. Also, companies that negotiated cost-sharing deals with their suppliers so they aren't bearing the full tariff burden alone. And of course, those premium brands we keep mentioning, high-end cosmetics, luxury sneakers, their built-in demand shields them.
But the landmines. The big risk seems to be next spring, right? What happens if demand does weaken when those fully tariff-loaded goods hit shelves?
That's the nightmare scenario for a lot of companies. What if they can't hold the line on prices? What if promotions start creeping back in to try and move inventory?
That would crush profit margins.
Absolutely crush them. It could lead to a margin collapse. We actually saw something like this play out back in the early 2010s when cotton prices suddenly spiked.
I remember that.
Retailers got stuck with super high-cost inventory. They tried to pass it on, but demand just stalled. Eventually, they had to slash prices, taking huge losses just to clear the stuff out.
And who's most vulnerable to that kind of squeeze this time?
Probably smaller companies, small-cap retailers especially. Those without massive scale or really strong must-have brands, they risk getting caught in the middle, rising costs on one side and weak, price-sensitive demand on the other. It's a tough spot.
And investors seem to be sensing this already. You can see it in the market charts.
Yeah, the market is definitely starting to differentiate. If you look at the broad retail ETF, the XRT, it's kind of stuck. Range bound, basically between 63 theory support and 72 tolerant resistance. That suggests overall uncertainty about the sector.
Hesitation.
Exactly. But then you drill down into individual stocks, and the picture gets much clearer. The divergence is pretty stark.
Give us an example.
Okay, take a major athletic brand, one that relies a lot on selling high volumes to the mass market. If you look at its stock chart, technically it's in a clear downtrend. It keeps hitting resistance around $80.
Meaning investors are skeptical.
Skeptical that they can raise prices enough without killing their sales volume and hurting margins badly. The market is betting against their pricing power, essentially.
Okay, now contrast that. What about a company with more luxury appeal?
Right. Look at a competitor focused more on luxury goods, maybe like Tapestry. Their stock chart looks very different. It's actually staging a strong breakout, finding support near $100, and the trend looks like it could be heading towards maybe $127.
And that strength comes from.
Confidence. Confidence in their brand appeal, their proven ability to raise prices without losing customers. Their business relies less on sheer volume and more on high-margin sales to loyal shoppers. That protects them from the price sensitivity hitting the mass market.
So money is flowing towards perceived safety and brand strength.
It looks that way. Volume patterns suggest a rotation towards these more defensive brand leader type names within the retail space.
Okay, so boiling it all down for our listener,
Hmm.
what's the key takeaway?
I think the main thing is, don't mistake the lack of a sudden price shock back in 2025 for the absence of inflationary pressure. The tariff situation isn't a quick lightning strike that's already over.
It's a slow storm.
Exactly. A slow-moving storm that's still gathering strength. The pressure is real. It's just spreading out gradually, hitting different categories at different times. So you need to think in terms of seasons, maybe even years, not just weeks or months.
So the real economic test isn't necessarily the inflation numbers we see today, but what happens next spring. It's about how long household budgets can handle this slow squeeze, especially when those fully tariff-loaded goods finally land on shelves.
That's the moment.
Keep a really close eye on how consumers react. Then do they keep spending or do they pull back? Watch for promotional activity from retailers. That's when we'll see the delayed impact of this tariff creep really make landfall. See you all in the next Pro Ticker Deep Dive.